Howdy, everybody. Welcome to Liberty Call for Monday, March 31st, 2025. Hope you're having a fantastical day out there in the interwebs. Kind of a gloomy day here in Colorado, but it's not cold, which is pretty nice. So hope you're having a great day and hope you had a fantastical weekend out there. Markets are bracing for impact as President Trump unveils sweeping 20% tariffs on all imports, triggering global sell-offs and renewed recession fears. Goldman slashes its S&P forecast, gold's hitting fresh highs, and rockets making mortgage waves with a $9.4 billion mega deal. So before we break all the news down, I need some help from you. Give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. Broadcast information before I get into all the news. There probably won't be any videos the rest of the week. I'm on vacation. My wife and I have our 29th anniversary trip, so we are going to be indisposed. So I might do some broadcasts. I don't know. Depends on Wi-Fi and stuff like that. And if you don't get a video from me the rest of the week, I'm still alive, hopefully. Hopefully she hasn't pitched me off the side of the ship. So anyways, all right. Well, let's get into the markets for today. All right. Dow Jones was up 1.12%, 465 points, closed at 42,049. S&P 500 up 0.7%, 38 points, closed at 5619. NASDAQ down 0.13, 22 points, closed at 17,300. The VIX was up 0.69% today. It's at 2180. Canada up 0.89, Brazil down 1.01%, and Mexico down 1.32. Headed to Europe, Germany was down 1.33%, UK down 0.88%, France down 1.58%, Netherlands down 0.95%, Spain down 1.31%, Italy down 1.77%, Switzerland down 1.74%, and Portugal down 1.23%. Russian exchanges both red today. MOEX down 0.33%, RTSI down 2.45%, and the overnight markets, the Nikkei took a real beating last night. It was down 4.05%. Australia down 1.74%, New Zealand down 0.27%. In China, the Shanghai was down 0.46%, Shenzhen Component down 0.97%, China A50 down 0.56%, DJ Shanghai down 0.66%, Hang Seng down 1.31%, Taiwan weighted down 1.59%. All right, so those are the markets for today. Let's jump into the weekly economic update. Stocks moved lower last week as investors swung from exuberance to disappointment on news over tariffs and inflation. The S&P 500 fell 1.53%. The NASDAQ retreated 2.59%. The Dow slid 0.96%, and overseas markets declined 1.29%. An up and down week. Stocks started the week with a sharp rally after the White House said it may, quote, give a lot of countries breaks, end quote, on reciprocal tariffs. The positive momentum continued into Tuesday with the NASDAQ and S&P 500 outpacing the Dow. Then midweek, news that the White House was planning additional tariffs on all cars made outside the U.S. rattled markets. On Friday, investors reacted to warmer than expected inflation report and lower consumer sentiment, putting further pressure on stocks as the week closed. All right, noise versus signal. There can be a lot of noise in the market from time to time. This can make it hard for investors to interpret information as they search for the actual signal. Last week, investors were trying to interpret the White House decision to impose tariffs on all cars and car parts made outside of the U.S. While some automakers are domestic and others are foreign-based, the question is whether companies will absorb the additional costs, pass them on to consumers, or look to build factories in the U.S. Separating the noise from the signal may take time, which can be more challenging when the markets react to new tariff updates as they are announced. Key economic data coming out this week. Tuesday is the ISM Manufacturing Index, the PMI Manufacturing, Construction Spending, and Job Openings. Wednesday, ADP Employment Report, Motor Vehicle Sales, Factory Orders, and Fed official Adriana Kugler is speaking. Thursday is Jobless Claims, the ISM Services Index, the Fed Balance Sheet, International Trade in Goods and Services, and Fed officials Philip Jefferson and Lisa Cook are speaking. And Friday, the employment situation, and Fed officials Michael Barr and Christopher Waller are speaking. No major companies reporting earnings this week, so we'll skip that section. All right, good stuff. Let's get to the market recap for today. S&P 500 in a Q1 loss despite jump. Liberation Day tariffs are looming. All right. The S&P 500 finished higher on Monday, bouncing from 6-month lows as bargain hunters stepped in, but the index still wrapped up the first quarter in the red. Investor attention is now squarely on President Trump's looming April 2nd Liberation Day, when a new wave of tariffs is expected. White House Press Secretary Caroline Leavitt confirmed the new tariffs will be country-based rather than sector-specific, though Trump hasn't abandoned his interest in targeting individual sectors. A weekend report from the Wall Street Journal added fuel to the fire, suggesting the president is considering broader tariffs against more countries to address what he sees as longstanding trade imbalances. Moving forward here, Trump already shook markets last week by slapping a 25% tariff on all non-U.S. made cars, effective April 2nd, with expectations he'll expand the list to include commodities, semiconductors, and pharmaceuticals. Investors worry these tariffs, which U.S. importers must pay, will drive inflation higher and slow economic growth. Goldman Sachs now pegs recession odds at 35% and sees inflation staying above the Fed's 2% target throughout 2025. Looking ahead, the big economic spotlight is on Friday's jobs report. Analysts expect 139,000 jobs were added in March, down from 151,000 in February, with unemployment steady at 4.1. Before that, job openings, private hiring, and manufacturing data will offer more insight into the economy. On Wall Street, Tesla is due to release Q1 delivery figures tomorrow, April 2nd, Wednesday, with expectations for year-over-year drop amid backlash against CEO Elon Musk. CoreWeave dropped more than 7% following a shaky IPO debut. Meanwhile, Mr. Cooper Group jumped 14% after rocket companies agreed to acquire it in a $9.4 billion deal. Kind of funny because I think it was the mortgage on this house. Or no, maybe it was the mortgage on my previous home was through Rocket Mortgage. And then I think they sold it to Mr. Cooper. Mr. Cooper is now my current mortgage holder. So they seem to be like more of a servicer than a lender. Jumping back in, vaccine stocks tumbled after top official Peter Marks resigned, raising questions over Trump's plan to overhaul federal health agencies. And that is the news of the day. All right. Well, let's get to one more article before we wrap up. This is the Monday Morning Outlook from Mr. Brian Westbury at First Trust. This week's article is titled Inflation, the Fed, and the Markets. So let's see what he had to say. The Federal Reserve's preferred inflation gauge, the PCE price index, is signaling trouble, not just in the short term, but for the Fed's long-term credibility. For the 10 years before COVID, PCE inflation averaged just 1.5% annually, well below the Fed's 2% target. Chairman Jerome Powell famously said that was too low and aimed to average 2% over time. Fast forward to now, and the Fed's gotten more than it wished for. Inflation has averaged 3.7% over the past 5 years and 2.6% over the past 10. Over the past year, PCE inflation has hovered around 2.5%, while core PCE sits at 2.8%. Barely down from the prior year. Even more concerning is the supercore metric, which strips out food, energy, goods, and housing, clocking in at 3.3%. The Fed doesn't talk about that much anymore. Despite tight policy, inflation is proving sticky, and the root cause might be monetary. The once broad consensus among economists that low inflation is essential has fractured. Today, with debt levels sky high and financial markets addicted to easy money, many policymakers find inflation's downsides worth tolerating. Compounding the issue, the Fed is fixated on interest rates and largely ignoring money supply, which grew nearly 4% in February. This could accelerate with the Treasury general account dropping by $400 billion in March, effectively pushing more money back into the system. Political pressure for rate cuts and a more dovish Fed may grow, especially with Powell's term ending in a year. Markets aren't fooled. Gold is soared past 3,000, and 10-year yields remain above 4%. Investors seem more concerned about debt and inflation than policymakers, and that doesn't bode well for Fed credibility or stock market valuations going forward. Very true. All right. Well, that's everything that I was going to cover for today. So if anyone needs anything from me, please go to, wait for it, DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be happy to help. Hope everyone out there has a wonderful evening and a wonderful week. And like I said, I might do some broadcasts while I'm gone. I don't know. It just kind of depends. Otherwise, I'll be back here in this seat on Monday of next week. So hope everyone has a wonderful day and a wonderful week. Adios.